Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. Oh boy, it's one of those days in the market where volatility spikes and fear spikes and the market goes red, especially for growth stocks. They got hurt the worst today. It seems like everyone is expecting inflation to be worse than estimates tomorrow. So they're taking today to sell out of their growth stocks ahead of what they think is everyone else. But it seems like everyone else also sold out of their growth stocks today. And Lucid, me oh my, did it take a mighty fall. And speaking of mighty, I did a video on Thor Industries. I posted that earlier today about their earnings and their potential growth. And I really do believe the market is missing it on Thor Industries. They are the manufacturer of RVs, recreational vehicles, motorized and towables. I just believe the market is just missing it on that one. So if you have some time, check out that video if you haven't already. There's a link in the description to that video to watch it. Now, the most important thing about this channel and this live stream, what's on your mind? If you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. So until your questions come in, and I'm looking forward to them, we always have a good time with them. I'm just going to give you a recap of what the market did today and what I'm expecting. And I've got a couple of deep dives that I want to do, like on Oxford and GameStop and also Cvs Health. They had their first investor day in over 2 years, and there was a lot of positive coming out of it. Also, my favorite, Aurora Innovation, they actually came out of nowhere, up 5.5% today. You would think growth stocks were getting hit. That is definitely a growth stock in a pure play on robotaxis. But no, that one came up today. So, yep, let's go ahead and just get right into it. And again, if you have a question, just leave the ticker symbol in the question in the comments and we'll go over it. All right, so we know that stocks did trade mostly lower today, ending a 3-day winning streak as traders try to assess what will be the impact of the new coronavirus variant on the economic recovery and, of course, the inflation data due out tomorrow morning. The S&P 500 fell 0.5%. The poor old Russell 2000, it fell 2.3%. It struggled with the steepest losses of the major indexes. The NASDAQ was down 1.7% as consumer discretionary and real estate stocks weighed on the indexes. GameStop was down 10.7%. Tesla dropped 6.3%. Amazon traded 1.1% lower. Meanwhile, the Dow Jones closed around the flat line after shedding more than 100 points earlier in the day. So, at least for the Dow, that was a nice comeback. Now, as according to the methodology, I guess I should say, the methodology of the gains in McDonald's, United Health, Home Depot, they outweighed the losses from Tesla and Amazon. Investors also turn their attention, of course, to inflation data due out tomorrow, which will likely show that inflationary pressures are persistent. Because remember, the word transitory, well, that's been retired now, and that word is no longer in use. Oh boy, I can't help but laugh when I'm thinking about that. All right, so strengthening the case for the Fed to double the pace, maybe on taper next week. So we've got a couple of speed bumps. Number one, tomorrow we have the inflation data coming out. It could be the highest in decades, right? And then next Wednesday, we should have a readout on the Fed meeting. Those are the two biggest speed bumps that the market has right now. If inflation fears are overblown, because remember, a lot of times The reaction in the market is an overreaction. And then next Wednesday, if the Fed comes out, and as long as they are not increasing rates too quickly, then the rest of December could be a little smoother. So we may have an opportunity right here in front of us for a little buy the dip opportunities with inflation tomorrow and the Fed on Wednesday. Then after that, we could have a Santa rally. That is a possible scenario for the markets for the rest of the year as we close out the year of 2021. Now, today, 9 of the 11 S&P 500 sectors closed lower, including, like I mentioned earlier, just consumer discretionary, also information technology, of course, the tech sector, and real estate, which I mentioned earlier. They all lost over 1%. The defensive-oriented healthcare was up 0.3%, and consumer staples was up 0.1%. Those were the two sectors that closed the highest. Fatigue seemed to reign in the market on the recognition that the S&P 500 has gained 3.6% over the past 3 days. Apple, well, it's gained 11.2% over the same 3-day period. So what happened to Apple today? Well, it lost 0.3%. Even though Morgan Stanley named Apple as a top pick for 2020 with a street high price target of $200. Now, the biggest gainers between Monday and Wednesday of this week were the biggest losers today. And those were typically the riskier stocks in the NASDAQ and Russell 2000. The ARK Innovation ETF, ARKK, which entered the session up 10% for the week, well, it declined 5% today. More on Cathie Wood in just a moment because she had some important comments that she made today. She's very bullish. Some think she's wrong, though, but we'll get into that in just a moment. In addition, there was a sense of caution in front of the Consumer Price Index report for November, which will, again, I think I've said it 3 times already, will be released tomorrow morning. Cvs Health, they were up almost 4.5% today, was an individual standout after providing upbeat guidance and authorizing a $10 billion share repurchase program. And remember, when a company offers a share repurchase program, that's rewarding investors. That provides pressure to bring the stock up. It's the opposite of when a company is trying to raise money and they add more shares to the market to do so. But more on CVS Health in a moment too. Okay, Bitcoin, well, it's fallen below that threshold that I keep talking about at $50,000. Here's Bitcoin on TradingView. You can see it's starting to look a bit messy, right? There's some extra fear here, but there was a positive in today's fall with Bitcoin that I hope Bitcoin can maintain. And that was that when Bitcoin fell today, it got to a low of 47,323. That's right here on an ascending trend line for Bitcoin, right? So it fell to that trend line and it bounced off of that trend line. To me, that's positive. That's better than it breaking down and producing a long candle like it did on Friday night, Sunday morning. But Bitcoin now below 50,000 is showing weakness. We've got to get that back up. So here's a possibility, or let's say a probability, okay? that Bitcoin follows this trend line up, right? And if it follows that up, when we get to right here, this is January 11th. On January 11th, that trend line reaches the $50,000 level. So if Bitcoin can get sandwiched in between here and stay above this trend line and below the 50,000, it would be building up strength and momentum to help break it above it and go ahead and push it up further away from that $50,000 level. That is one possible scenario. Another scenario is that Bitcoin falls, breaks this trend line, and then we get to the 200-day moving average, which right now sits right about 46.5, 46.6, about somewhere in there, right? That's where the 200-day moving average is sitting. Now, of course, Bitcoin has a history of breaking below the 200-day moving average and not holding a candle to it. So it is another possibility that it could continue down. And if it breaks that, this is looking really bearish. I mean, right now, it is looking pretty negative, but I do stay positive on Bitcoin in the long term. Short term, that is, it almost looks like Bitcoin is confused, right? It's not sure which way it could go. There was a hearing yesterday in Congress, and a lot of the executives from many different players in the crypto space were talked yesterday, and it was rather positive in my view. They also talked in Congress about a framework for Bitcoin to be regulated. And I think regulation for Bitcoin and other cryptocurrencies in general is a good thing, as long as it doesn't prohibit growth. And when I say growth, I mean technology-wise. As long as it doesn't interfere with the technology, the innovation of blockchain. That would be good, because there's a lot of money on the sidelines, a lot of institutional money on the sidelines that are not involved in Bitcoin. And if you want to get Bitcoin to the $100,000 level, you need that money, that institutional money on the sidelines in as well. And the only way they're coming in is if there's some sort of regulatory framework for cryptocurrency. So that's one reason why I am for some kind of regulation, as long as it doesn't hurt the innovation of blockchain. Because blockchain, it can do a lot. It can do a lot to our financial system to strengthen it and make it more inclusive. All right, let's hop over and look at Ethereum next. ETHUSD on TradingView. And if I haven't said it already, there is a link in the description to a free TradingView account. It's where we do all of our charting, all the charts that you see. Now, Ethereum falling today almost 6%, it really doesn't look like much, because it still looks like it's in the exact same pattern. While Bitcoin looks to be in a downtrend, Ethereum doesn't. Ethereum just looks like it is moving sideways, right? So it's looking good. $4,000 is the level for Ethereum that it needs to stay above. And it does a really good job at it. Most of the time, when Ethereum gets to the $4,000 price, if it goes below it, it rubber bands right back above it. That for Ethereum really provides the buying opportunities. Okay, let's get into stocks now and off of crypto. First, I want to look at a new publicly traded company, Boxed. We've been talking about them a little bit this week. I talked about them yesterday, talked about them in the after hours show. BOXD is the ticker symbol for Boxed. Now, Boxed was up today a nice 31%. It got up much, much higher today. I traded this one. It stopped the you know how they will stop trading for a security when it has run up too fast, or if it's coming down too fast, they'll pause trading at the exchanges, not at the brokerages, but at the exchanges. That happened a lot this morning with Box because it was just going up and up, 20%, 20%, another 20%. It was just going up and up and up. So it settled today up just over 31%, 31.39%, and it's up 2% in after hours. This is one that I've held for a while now. Been holding it since the $8 and some change down there. Been holding it for a while. Been waiting for this to come through so I could trade it. But we talked about it yesterday. We talked about it on Sunday evening's Catalyst Watch video, which is the most important video I do. And since today's Thursday, right? Well, Sunday evening, watch for a new episode of the Catalyst Watch. And you'll hear something in there that maybe can help you in the week coming up. Okay, Cathie Wood was back in the news today. So let me pull up ARKK. All right, so ARK's got many different ETFs for many different themes, right? Well, their main theme is the ARK Innovation ETF, and that is ARKK. They have been in a downtrend for a while. If we look at their performance on the year, they are actually down 21.5% year to date. Now, last year, Cathie Wood's funds did incredible. There were excellent returns. Now, Cathie Wood remains very bullish. And she's buying a lot of companies that have sold off quite a bit. And she's got a reason for that. Now, Cathie Wood, she's the CIO or CTO, excuse me. No, investor, CIO, Chief Investing Officer, and the CEO, Chief Executive Officer, right? Chief Investing, Chief Executive. So she got two roles at her company. But she defended her innovation strategy and clarified to the market that ARK's latest ETF is not an ESG fund, but rather an impact fund in an interview with Bloomberg Television today. So many of ARK's ETFs are trading to the downside with double-digit losses on the year. Like I just showed you for their main ETF, the ARK Innovation ETF, which is ARKK. Now, Cathie Wood was asked at what point would she rethink her thesis on some of the stocks that ARK holds, and how her approach and how she's approaching, excuse me, and how is she approaching that situation? So during a period of uncertainty where ARK's funds are out of favor, Cathie Wood said they usually consolidate towards their highest conviction stocks. And those stocks are held up in the top 10 spots of each ETF. So you're looking at names like Tesla, Roku, Teladoc Health, Square, Shopify, among others. But she says the top 10 convictions, they consolidate around those names. Now, Cathie Wood also added that the reason that ARK consolidates its holdings during a downturn is that most of her competitors are selling, quote, our stocks, right? The Cathie Wood stocks. Most everyone is selling her favorite stocks in a risk-off environment like we found ourselves in today. And trying to get, I guess what she was saying is her competitors were trying to get to a more defensive stance. And a lot of Cathie Wood stocks are growth stocks, and growth stocks are not defensive in any way, shape, or form for a portfolio, right? So that's one thing, right? And the RK is their pick. And RK is what Cathie Wood said. And RK is there to, quote, pick up the pieces left behind. So that's why she buys the stocks that others are selling, because she has, and her team, because of their impeccable research, has high convictions in those stocks. Now, what can we take away from her thoughts as investors? Well, with our own portfolios in a market that's turning down, we should pick a handful of our own highest conviction stocks and consolidate around them. So if you have a portfolio, maybe you've got 30 different companies. Well, if most of those 30 companies are growth stocks or don't do good in a down market, then maybe squeeze that to 20, 15, or 10 stocks that you have the biggest belief in, that you have the highest conviction in. Sell down on the others and use that cash to lower your cost basis in your highest conviction stocks. Just dollar cost average in as the market goes down each red day, buy a little more and dollar cost average down. That's one thing that we can take away from what Cathie Wood said. Now, Cathie Wood said that she does remain focused on her company's 5-year projections. Okay. So that's another thing that we can take away from Cathie Wood, is that with the stocks that she's holding, and let's just say her top 10 stocks, right, in each portfolio, she's not looking at how they're going to do this quarter or next quarter. She's looking at how are they going to do in the next 5 years. Let's not worry about the short term here. What are they going to do in 5 years? If they're going to be winners and they're going to run over the next 5 years, that's what we want, right? So she also said that based on their very disciplined research, Cathie Wood expects, now hold on for this one, a compound annual rate of return of roughly 40% over the next 5 years. So what Cathie Wood is saying is that if you believe in her strategy, you're going to be making a compound annual growth rate of 40% over the next 5 years if you follow with her. If she's right, you're going to be rewarded very nicely. If she's wrong, then you'll probably be upset with her. It's really that simple, right? Do you believe that the companies she is the most convicted, has the most conviction for, will do well? Then you'll do well too. So just a couple things there that she said. Okay, moving off of Cathie Wood. We've spent enough time talking about what she said today. Let's go through a couple of earnings, rapid fire. There were some good ones and some bad ones. Let's start with Broadcom, ticker symbol AVGO. For Broadcom, they reported their Q4 earnings. They had an EPS of $7.81, and that beat by 4 cents on revenue of $7.4 billion, which was a 14.4% year-over-year gain, and that beat by $40 million. Now, their Q1 guidance, they're guiding revenue of approximately $7.6 billion versus the $7.2 billion estimated. So a slight increase. Now, the biggest thing here, the board has authorized a repurchase of shares of up to $10 billion of its common stock under a new repurchase program. The share will be repurchased by December 31st of 2022. Now, the current share repurchase accounts for 4.1% of the total market cap of the company. They also declared a $4.10 share dividend, quarterly dividend, a 13.9% increase from the prior dividend of $3.60. So if you're looking for a company that's paying out a pretty nice dividend and is going to continue growing in the future, Broadcom is a pretty good name. Their yield for their dividend is 2.45%. So that's pretty good. So that's Broadcom. They're up 6.7% in after hours right now. So they're looking pretty good. Now, they have had a really nice bounce off or real close to their 200-day moving average at the beginning of October. And they have just been running up a very nice rally in October, pulled back here at the end of November, and now has taken off again. It has just been really, really moving. If I move this chart here, I actually have to pull the chart down, right, to show you where the stock currently is sitting at, because it's sitting up here where this purple line is that I just drew. That's where the stock is sitting at right now, being up. Hold on, click the right buttons here. Okay, so this purple line, that's where the stock is sitting at right now after its 6.78% gain in after hours. So investors are really liking that buyback, really liking that dividend increase. So it's a hefty one right now. So I wouldn't go chase this one to get in now. I would wait for it to pull back before getting into it. All right, the next one up is CHWY. Ticker symbol is CHWY. Now, remember, we talked about CHWY earlier in the week because of the True Companion partnership, so they can offer pet insurance. Well, things just did not look so good for them. Now, in this falling or descending triangle right here, this is typically what you find. When you have this flat bottom line, this flat bottom of support, it's not angling up to make this a symmetrical triangle. It's flat at the bottom, and the resistance line is in a downtrend. It's descending. This is a descending triangle, and usually that means that it's going to continue going down. And it was down 6.3% during regular sessions and 8.1% in after hours. It has fallen further. So over a 10% drop here today. Not very good for CHWY. Now, they had their Q3. They had EPS at a loss of 8 cents, which missed by 4 cents on revenue of $2.21 billion. And that was a 24.2% year-over-year gain. And that was in line with estimates. So they really didn't shine here, and guidance wasn't very good either. So unfortunately, CHWY is continuing its overall downtrend that it has been in. Now, it has now missed on both top and bottom line numbers for now 2 consecutive quarters in a row. So again, they got to turn it around if they're going to do anything. All right, next up, a good one is Costco, ticker symbol COST, COST. Costco, this is one of my favorites. This could be viewed as a defensive play as well, because they sell what we need in as an everyday usage, right? They've been in this really nice uptrend. They kind of broke out of it, got ahead of themselves, pulled back down into their trading channel, and then popped out of it again. Now they are back in line in their trading channel, which is all right. They're above their 50-day moving average, but below the 21-day moving average right now. They were down a percentage today during regular session, and up nearly 8% in after hours. Now, their EPS of $2.77 beat by 12 cents on revenue of $50.36 billion. Man, they bring in a lot of money. And that was up 16.5% year over year, and that beat by $610 million. Now, adjusted comparable sales in the US was up 9.9%, Canada 8.3%, other international 10.9%, and the total company 9.8%. Now, e-commerce was actually up 13.3%. So they saw a really nice gain there in international stores and with their online shopping. All right, another one, Lululemon, ticker symbol LULU. They posted their Q3 earnings of $1.46, and that beat by 4 cents with revenue of $1.45 billion. And that was a 29.5% year-over-year gain, and that beat by $10 million. Now, for their Q4 21 outlook, net revenue in the range of $2.125 billion to $2.165 billion. So not a very big spread there. But the estimate was $2.17 billion. So their guidance is weak, and that can be shown in the stock, down 2.1% during regular session and down another 2.1% in after hours. It's about ready to fall under that $400 mark. If inflation is bad tomorrow, I think it will definitely fall below $400. All right, another one up for earnings was Oracle, ticker symbol ORCL. And we'll talk about Lucid here in just a moment too. All right, so Oracle came in with their Q2 EPS of $1.21, and that beat by 10 cents on revenue of $10.4 billion, which was a 6.1% year-over-year gain, and that beat by $190 million. Now, they're being rewarded heftily, did I say that right? 10.4% increase in share price in the after hours. So again, this one, if you're looking at where it closed down here, right? But the stock is currently up here. So that's the 10.4% jump right there in after hours between those two lines. So looking good for Oracle right now. And this stock, it has been running for the most of from October through the beginning of December, using its 50-day moving average to bounce off of to continue another little rally, hit the 50-day moving average, another little rally, and so forth. It's been really nice. I believe over the past just few months here, year to date up 37.2% year to date. All right, so that's Oracle looking much better. Now let's talk about CVS. CVS is the ticker symbol. Cvs Health is the full name there. Now, they haven't had an investor event in 2 years. So having this investor event, the stock was up 4.5% during regular session, and it's up 0.3% in after hours. Really nice moves. Now, CVS Health, let's talk about this one a little bit, okay? Ahead of its investor day today, their presentation, CVS Health issued a press release detailing its strategy to become a more comprehensive provider of healthcare services while updating its outlook and capital allocation plans. It's the latter part of the report that immediately caught investors' attention, as CVS lifted its fiscal year 21 EPS and revenue guidance above expectations. And whenever you see a company do that, you can anticipate that the stock will go up when that news comes out. That is always a positive catalyst on a stock, because I say it all the time, the stock market is nothing but a prediction or a probability of what the company, the underlying company of the stock, will do in the future. So if a company is upgrading and it's upping the ante on its guidance, the stock will follow. Now, of course, there are exceptions to every rule, and there is to that one. But for the most part, that's what stocks are following. Guidance. Okay. Now, they also announced a whopping $10 billion share repurchase program. Now, I talked about this a little bit earlier. When companies are doing a share repurchase program, they are buying shares from the open market, and that helps to increase the price of each share, right? Whenever there's extra buying, a stock goes up. So this is a way to reward investors. It's the complete opposite of when a company is issuing shares to raise money for themselves. This is the company giving the money back to shareholders. Now, shareholders can be rewarded in many different ways. With the share repurchase program, that should cause a stock to appreciate, go up, right? Companies can offer dividends. Companies can offer a special one-time dividend. And those are just ways for the company to reward investors. Now, in addition to the enhanced outlook and buyback program, the story that emerges from CVS's update is that the company is accelerating its monumental transition, shifting further away from a retail model towards a diversified healthcare provider model. This is what I predicted earlier when we were talking about this yesterday or the day before, and in the Sunday evening's Catalyst Watch video, that they would be going more in this direction of becoming a healthcare provider. And that's exactly what they are doing. Now, recall that on November 18th, CVS announced plans to close about 300 stores per year over the next 3 years in order to reduce store density. This initiative, which isn't expected to materially impact adjusted EPS this year or next, represented a key step in the company's transformation process. Now, the reason they are selling stores is because they made an acquisition years ago, which increased overnight the amount of stores CVS had. Now, they're trying to shed some of that, get rid of it. They don't need a CVS on every corner in a major city or a town somewhere, right? Not like a McDonald's. They can have one in a central location, right? And that will be just fine. Now, with the competition in the drugstore space having intensified due to the entrance of e-commerce giants like Amazon and Walmart, CEO Karen Lynch is steering CVS into new growth avenues, primarily including care and home health services. The ultimate goal for CVS is to win a larger portion of total U.S. healthcare spending. This doesn't necessarily mean that CVS is going to de emphasize its brick and mortar retail business. The main objective is to the main objective of its retail portfolio, though, is changing as the company evolves into a healthcare provider. Specifically, more floor space will be dedicated to primary care centers and health hubs, which are capable of treating patients with chronic diseases, more serious conditions as well. Also, nurse practitioners will become available in the stores, with as much as 20% of the floor space allocated for consultations. In the healthcare benefits segment, CVS will launch new products and offerings such as home health services, health related subscription platforms, and I love those subscriptions, and the commercialization of healthcare analytics and insights. Not only will these offerings provide new revenue streams, but they should also help keep costs of care down for the Aetna business. COVID-19 has created a formidable headwind for Aetna due to rising health insurance claims. And the emergence of new variants has created some angst that cost of care will remain elevated. By providing home health services and health monitoring platforms, Aetna members can keep a closer tab on those conditions, primarily transitioning into lower costs down the road. Lastly, expanding and enhancing its digital and omni-channel capabilities will play a key role in CVS's growth strategy. A valuable asset for CVS is its $35 million online members, which is quite a bit for a CVS, right? Of course, not compared to a Walmart or Amazon, but that is changing. The company can access or has access to launch new services such as virtual healthcare. Think of Teladoc Health, right? And online ordering and delivery of pharmacy products. Overall, CVS had plenty of good news to share, and its vision of transforming into a well-rounded healthcare provider is resonating with investors. One blemish is that its fiscal year 22 EPS guidance of $8.10 to $8.30 is slightly below the $8.24 estimate at the midpoint. However, CVS's substantial share buyback program and its prospects for stronger top-line growth in the years ahead are offsetting any disappointment related to its fiscal year 22 earnings outlook. What do you think about CVS? It's an odd one for sure. I'm not sure if many of you are invested in CVS Health or not. I personally am not, but I do find their story actually pretty interesting. All right, let's see here. Zscaler has been volatile of late. Went down to 270, back to 317, and down to 303. Yes, and it will continue to be volatile, especially with CPI data coming out tomorrow. Anytime we get to that time of the month where inflation data is emerging, growth stocks, tech stocks get hit the hardest because inflation is a hidden tax. It's a tax that Congress doesn't talk about. It's a tax on cash. So if a company is bringing in high levels of cash and then the money is just sitting there in a bank, it is losing. Let's say inflation comes in at 6%, just a nice round number. So that means 6% of every dollar that comes in and then is sitting in a bank account somewhere for a growth stock or a tech stock like Zscaler, they're losing 6% of every dollar due to inflation. That's a hidden tax. It's also a hidden tax for you as well. That's why these companies that do have cash flow and a good balance sheet, tech companies, big margins, get hurt when there's high inflation because of that hidden tax. Because remember, the stock market is nothing but what is a stock going to look like in 6 months, in 12 months, in 5 years? And that's what, excuse me, and that's what a stock's price is based off of today, what the stock will look like in a year from now. That's why we have PE ratios and other ratios that can give you a number or a percent based on, sales from a year from now or sales from 2 years from now. So Zscaler, it's staying above the line that I have here drawn in the sand for them, which is a positive. For me, this top line right here of 260, let's see how close they came to that. They haven't broke under $300 yet. They got to $300.54 on December 3rd. That's the lowest they've gotten. Now, they have been marching up over the past few days, but they ran into a little trouble here at the 50-day moving average. It's acting as resistance. But if we look at this overall, and I put this line here to show from this bottom up to where it is, just like that, you can see that while the price is fluctuating, it is in a bit of an uptrend. However, it is bumping into that 50-day moving average and it's acting as resistance. So it could end up just moving sideways within this area right here and bounce around. The good thing is that it hasn't broken below this support level of 260. That's important. $300 is also a psychological level. Round numbers are always psychological numbers, right? Because people just for some reason just like them. But there's a couple things to point out besides this uptrend that they are in from the bottom of December 3rd. volume is in an uptrend also. The RSI, it's slowly starting to hook and turn up. So those three things together are positives for Zscaler, but they're going to struggle a little bit with the higher inflation. Their future returns are shrinking at over 6% right now due to inflation. So that's something that investors are taking into account. Now, inflation is expected to be the worst it's been in decades tomorrow. So I would expect growth stocks and technology stocks to also be red. So it could break this trend line tomorrow and fall under this. But that's where it's at right this second. Facebook will be a safe haven for tech during inflation news time. Yes and no. Your best defensive plays are your consumer staples. They don't go anywhere. We always need them. Also, defense. Things are getting pretty heated. Defense stocks are going to be very valuable. But looking at Facebook here, we've got this support line down here at $300. It came close, $299 and 50 cents. So it broke it by 50 cents, popped right back up. Good rubber band. But as you can see here, it's also been in an uptrend. However, it got to its 50-day moving average, and it also acted as resistance for them too. So this could be a situation where these bigger companies or technology companies they're just going to start moving sideways, and they're going to be range bound until we can get out of this inflation hole. Another thing with technology stocks is if the Fed, not if, when the Fed raises its rates, that will also hurt growth in technology stocks, more so than any other sector in the market. Now, if I had to pick between Zscaler or Facebook, I would pick Facebook over Zscaler. Airbnb has reclaimed 21-day EMA, looking good to buy. Let's see. Airbnb. All right, let's see here. Okay. All right. So for Airbnb, what needs to be watched out for at Airbnb is news of the different variants. If there are restrictions placed on travel, like right now, international travel is difficult. There are protests erupting in Europe over lockdowns and restrictions. As long as we don't see those here, then there's a better chance for Airbnb. I like Airbnb for the long term. I think it's a fundamental change in the way people travel and where they stay that should see years and years of benefit. Now, it looks like the last downgrade for them was on December 2nd, and USB came out with a neutral rating. and a price target of $176. So 176, that's real close to its 50-day moving average, a few bucks above it. Now, the positive thing about yesterday is it did get above that 50-day moving average, and for yesterday and the day before, it was back in its trading channel. And that's where I want to see it. I want to see this thing get back into its trading channel. For me, right now, it's not a buy. For me, I want it back in this trading channel before it's a buy, because it could very easily be at the top right now in a very short term. So let me just draw this out. It's easy. So here it is, just under the trend line support for its trading channel. Now, it hit that 21-day moving average today, and it's now below it. Yesterday, it was above it, and this is the simple moving average. So what I could see happening here is this being a top, and then it coming down, maybe trying to hold on to that 50-day moving average, maybe come back up after it hit it, find resistance again somewhere probably around either the 21-day moving average or the bottom of the trend line, maybe as resistance, and then come back down again. That's a potential that I could see. That's one possible probability. Another one is that maybe it does come down tomorrow because of inflation, and then people are more inclined to wait until after the Fed releases their minutes and they give their talk, or Powell gives his talk on Wednesday, and then maybe it, after going down, can get back up into its channel here and maybe bounce around on the bottom of its channel here. That's when I would buy. Once it got into the channel, it back tested the channel and then continued up, that's when I would be a buyer. Why is that moving? Okay. If the rates are for sure to go up, how come the bank stops? How come the bank stops are not moving? Bank stocks. Okay, I got you. How come the bank stocks are not moving up? Because it's already priced in. We already know that rates are going up. We know it's going to happen. We know that there's going to be 2 rate hikes next year. Most likely August, maybe as the earliest. But that would be one reason, because it's already priced in. Now, I don't study the bank stocks. I don't invest in the bank stocks, and I don't watch them too closely. So I'm not an expert on any of the bank stocks. For sure. Let's see here. How much do you think the Fed next week and or bad inflation report tomorrow affect Roblox? Its range has been pretty violent and volatile since earnings. Okay. That's one we talk about every once in a while. Roblox, RBLX. All right, just had to fix that for a moment. Okay. All right. Roblox is really a great play for the future. However, I think Roblox has been extended right now, and I think it is a bit extended. Look at this on a view like this. All right. You can see where it became public. It started trading. It started forming a wedge, and then it broke out of that wedge perfectly, just like it textbook should. However, right now it is overextended, and I think inflation data is going to hurt it. I think Fed raising rates is going to hurt it, even though some of that's priced in already. The inflation so much isn't. So I could see Roblox actually coming back down at the very least to its 50-day moving average. And right now, that's sitting all the way back down at $95. So that's a pretty steep fall. It probably won't happen all at once. The probability of that happening is pretty slim. Now, it has a good base down here between $75 and $85. It built up a nice base there when it was in its symmetrical triangle. Then once it popped out, great run, good trade. But I would not be getting into Roblox at this moment. I do think it's overextended, and I do think it will come back down. I think inflation will definitely hurt it. It's a growth company. It's a, excuse me, it's a play on the metaverse. So yeah, I think it will come back down. And right now, I'm not seeing a base getting formed up here. Yeah, there's a couple of touch points around the $116 mark. There's 1, 2, 3 days in a row at 116, and then one more back on November 24th. But outside of that, there's nothing holding it up here. Would love to pick up below $80 again. I think you'll have an opportunity to pick it up in this zone at some point. I think the next few days are going to be difficult for growth stocks because inflation is going to be the headline. Everyone's going to be talking about, and that's going to hurt growth stocks. It's going to hurt tech stocks. It's going to hurt companies that have a lot of cash flow. Yeah, so I think it will come back down. And then with the Fed next week, that's just more selling pressure on these type of stocks. But then after that, after those two events have passed, and after the news of those two events start to move behind us, then I think it is possible for the last couple weeks of December into January to some degree that we could see an uptick in the market, in the overall market. That whole Santa rally that you keep hearing commentators bring up every now and again recently, and it's back on everyone's mind that, hey, you know what, maybe it's possible that we could have one of those after we get past these two specific deals, the inflation tomorrow and the Fed next Wednesday. Once that is done and over with, then I think we can start moving up again. Because if you look at the S&P 500, here, let me pull it up so we can look at the structure that it's in right now. The S&P 500, even with its pullback today, is still up here above that 21-day moving average. And if we look at how it's been reacting this year, let me fix this chart. There we go. If we look at how it's been reacting this year, it uses its 50-day moving average as support, but in between its pullbacks, it uses its 21-day moving average as support. So, I mean, a prime example, I mean, just the whole year is an example, except for the problem that we had back in September, and then, of course, the October rally. But you can see it. The blue line is the 50-day. It bounces right off the blue line every time. And then in between those pullbacks to the 50-day, it's using the 21-day, and it rides right along it. I think that we could potentially see that type of setup, this one right here. This setup that we had right here. I think we could see this setup in the market after we get past these two events. Inflation tomorrow and the Fed on Wednesday. And then I think we could get back into a pattern like this through the end of December and into January. And then we'll have to have a correction at some point because we haven't had a big correction yet. I mean, all this year, we have not had a correction over 5% all year long. And that's rare for a market. How do you think the two events will affect SoFi? Negatively. But SoFi is one that I own. I love SoFi. I think it's a great company. I think SoFi, you buy it now and you hold it for the long term, 5 years, 10 years. Right now, SoFi is bumping up against this symmetrical triangle here. And it's using this line as resistance, but it's bumping into it right now. Finally bumping into it. But right now, I think inflation tomorrow, it's going to bring it down. I mean, it was down 7.5% today. I think it could come on down tomorrow. And I really think it could get to this zone down here. Let me raise that up a little bit. Oh, come on. There we go. I really think it could get down to this zone of maybe hitting under the $15 mark. And then maybe finding support 1475, because that's a zone that it's hit many times this year. It'll fall under $15. It'll get down to about the 1475, maybe as low as 1450 in there. And that's been a zone for SoFi to bounce off of several times this year. I think it could do it again with tomorrow's news, and then of course the Fed talking about being hawkish to cool the economy down, and all the Fed speak that they use. So I think SoFi is going to be hurt. I think SoFi is coming down even further than it did today. But again, that zone that it finds itself in all this year is a possibility for where it could hold up. And this bottom support line is actually running right into the bottom of that 1475 price support, or the price zone that SoFi has been in. If it gets below 1450, it's definitely a buy. Absolutely, yeah. I've been buying SoFi the whole way down on this one. That's how much I love it, and how much of a, I guess, to speak like Kathy Wood, how much of a conviction I have in SoFi. So I think it's a good company. The bank charter, that's a matter of when, not if. last week, couple weeks ago, maybe the CEO or one of the executives, I think it was the CEO, was doing like a fireside chat, and the bank charter was brought up, and he talked about how good it would, how the good things that it would do for SoFi. So it hasn't been shut down yet, and it's still in play. And I think that news is going to be one of the biggest catalysts SoFi has ever seen as a publicly traded company. But we do have to get over these two little setbacks here with inflation and Fed. I like to sell puts at the 14,450 and the $15, and it's been working pretty good so far. Yeah, those are good areas, definitely. Because that's, like I've said, all year long, it gets to that point, and it's just been a pinball for it there to bounce off of and to hit around. I mean, there's all kinds of different times. Back here in April, it did it. Back here in March, it did it. Almost got to it at the end of March again. Did it again in May, beginning of May, middle of May, middle of July, end of July, beginning of August. I mean, it bounces in that area so many times this year. I definitely expect it to get back in there again today. Over the next few days with inflation and Fed. Okay, well, we'll keep rolling. Any other questions, feel free to leave them in the comments. We'll go over it. There's one that I wanted to talk about. If you guys would like. Otherwise, we can just keep going with what's on y'all's mind. That's fine. Otherwise, there was one company, actually a couple. I wanted to talk about GameStop for one. Also wanted to talk about Oxford Industries. It's a clothing manufacturer. Thank you for that. I greatly appreciate that. Thumbs up right back to you. Oh, thank you so much. That is greatly appreciated. It's funny here on the chat side for that sticker. It doesn't show it. You're welcome. I'm here every day, 5 o'clock Eastern. Here for an hour or two, whatever it takes to answer your all's questions. But here it doesn't show the sticker. It just says pair character stretching his arm forward, raising his thumb. It's so funny. Here, I'll do this. Yeah, on my side, I don't see the actual character. This is what I see. Thank you for that. I greatly appreciate it. Okay. Oxford, that's one that I wanted to talk about, and GameStop, and those are the only two other ones I wanted to go a little bit deeper on to talk about. I think there's some interesting GameStop. I don't know. There's some things that I like about GameStop that I think people are overselling on. But yeah, we'll get into those. We'll talk about them. But of course, anything on your mind, that's first and foremost what I want to talk about. So if there's no other questions right now, I'll dive into those two companies a little bit deeper here. Otherwise, I'll get to your questions, whichever you would, whichever direction you'd like to go. All right. So Oxford Industries. Let's pull those up here. All right. I'm just loading over here on my side. Okay, just a moment. Okay. All right. So Industries, they posted their earnings today. They had a big old red candle, uh, but it's only 3.8%. It looks bigger than it is. There we go. Now it looks a little bit more in line there. This is a company for the year. It was moving up at the beginning of the year, and then it kind of moved sideways, dipped down a little bit during the summer. But their earnings came out today. Put a vertical line there. It is a dividend-paying stock of 1.6%. But Oxford Industries, they are what I would say, to kind of give a background for it. They're sitting on a beach somewhere today. They're an apparel company which owns Tommy Bahama, Lily Pulitzer, and Southern Tide. It focuses on a laid-back vacation vibe type of apparel. The pandemic really took a toll on its business in 2020. However, now that people are coming out of, I guess we could say, hibernation, one way to say it, right? Oxford Industries is seeing a lot of pent-up demand because its brands focus on travel, vacation, and social events. I was expecting a good result for Oxford, but even with those expectations, Q3's numbers were eye-popping. Adjusted EPS of $1.19 demolished the 20 to 30 cents prior guidance that the company gave, while revenue managed a big beat as well. Guidance for Q4, which is in January, was a bit more muted, calling for generally inline EPS, but the midpoint was below expectations. However, given Q3's huge upside, Oxford's Industries might just be guiding conservatively. That's always a possibility. Oxford Industries' Q4 revenue guidance exceeded targets. The company reported a standout increase in margins in this quarter as well. Adjusted operating margin jumped 11% versus 1% in 2019, and that was before the pandemic. And that features growth in all of its brands. Its expansion was driven by a higher proportion of full price sales. No 50% off, no coupon code, none of that. Full price for their products for the overall. And that helped with EPS. And an overall shift in a sales mix to higher margin direct to consumer channels. No third-party vendors involved. That also helped. Now, drilling down, Oxford Industries posted 40% growth in its full price DTC business versus 2019, with growth in each of its brands. That included a 13% increase in full price retail and 100% jump in full price e-commerce. It's a testament to the strength of Oxford Industries brands that it has been able to avoid discounting even as consumers feel the pinch of inflation. This is a strategic decision. that helps to keep its brands viewed as premium purchases. While Oxford Industries is seeing retail sales recover, what investors may not realize is that Oxford Industries has a fairly small retail store footprint in the first place. The majority of its sales are made online, with the number was 70% of total sales in Q3, and they also saw that going up to 80% over time. This helps boost margins and allows Oxford to avoid some of the inventory supply chain pitfalls that many other retailers have faced. I also wanted to mention that Q3 marked Oxford's exit from the is it Laner? I think it's Laner apparel business, Lanier. I think it's Laner, a long A. This was an important milestone for Oxford. I don't think investors realize that its long-term strategy of focusing on its own brands can now come more into focus with Laner. It was the last of Oxford's legacy private label businesses. So that is now gone. That will help profits. And I think investors are missing that key detail. Overall, I was very impressed with Oxford's Q3 results, and I'm not concerned about the Q4 EPS guidance given that Oxford said on its last earnings call last night that holiday sales to date have been robust. A unique thing about Oxford's brands is that they are more closely tied to travel than other brands. As such, they were hurt more during the pandemic, but they are now benefiting more than other brands as people resume traveling. Of course, not really international traveling, but that's beyond the point. That just shows that there's still locked up growth for Oxford moving forward. Anyways, their products are viewed as high end. I think investors are missing the one point about the Laner brand being gone now. It's completely out of the business. And they're related to not really other retail players like maybe a Gap or a Macy's, but they're more related to maybe a hotel or airline because people buy their clothing when they go on vacations. So there is still a lot of pent-up demand around vacations. And most people just aren't taking vacations like they used to. That is also further growth that Oxford could see. So let me know. What do you think about Oxford? Is it worth a look or your pass? All right, GameStop. Let's talk about this one. Ticker symbol GME. GameStop, boy oh boy, can it move with bursts of energy. You can see there's a band here, a price channel that GameStop has been in almost all year. Once it came back down in the beginning of March here, it's really stayed in there. Earnings back in June, it pumped up out of the range, but then fell back into it. It pumped up out of the range here on November 22nd, but then fell right back in. This range has a bottom of $147 and a top of $224. It's range bound right now. It's a good trade because you can trade within this range pretty successfully, pretty constantly, right? I mean, you can see the rhythm that it's making. Now that it's on the bottom side of the channel, well, I maybe expect that investors might start buying again. It's a possibility. But they did miss on earnings today. So we need another vertical line there for earnings. RSI right now is at 33. So it's really close to being oversold. It was down 10.3% today, but it's up 0.3, almost 0.4% in after hours. So GameStop, this is a favorite among momentum traders, especially retail investors. It is powering down now after issuing a mixed Q3 result, while once again refraining from providing specific guidance. The wild volatility in GameStop's stock is not only a function of speculative trading activity, like we just talked about, but it's also tied to the company's transformation. We know the company is going through a transformation process right now as physical game, well, they're becoming obsolete. GameStop really needs to transition itself, and it is. But that is why we got a mixed earnings report. And that's why we got guidance that is more mysterious than it is at answering questions. So with GameStop badly missing on the bottom line, it's clear that the company's turnaround efforts are still a work in progress. Not a bad thing. When GameStop appointed Matt Furlong as its new CEO, and they had a new CFO on June 21st, the company's plan to reinvent itself kicked into motion, with both executives coming over from Amazon, ticker symbol AMZN. The writing was on the wall that enhanced e-commerce and digital capabilities would be the hallmark of GameStop's transformation. Therefore, it doesn't come as a surprise that the company ramped up hiring in areas such as e-commerce, supply chain management, helping it to accelerate delivery times and improve the customer experience. On the topic of hiring, reports surfaced in late October that GameStop was looking to add Ethereum and NFT specialists to support its plan of building an Ethereum-based Web 3.0 gaming unit. During the earnings conference call last night, Furlong admitted, or affirmed, I should say, that the company is indeed exploring opportunities in blockchain, NFTs, Web 3.0 gaming, and so forth. So GameStop's vision is that games will be places to go as gamers virtually intersect or insert themselves into a virtual reality environment. Think of the metaverse. In this scenario, blockchain technology would be used for, what word could I use? Maybe as a communication purpose, maybe. I don't know if that's the right word. But the upshot of this increased hiring activity and ramp up of technology investments is that SG&A cost grew by 17% year over year to $421.5 million. At the same time, GameStop experienced an unfavorable sales mix as lower margin categories like new console hardware became a large piece of total revenue. The reopening of stores and higher freight costs compounded the issue, causing gross margin to slide by 290 basis points year over year to 24.6%. Despite a solid 29% jump in revenue to $1.3 billion, GameStop's operating loss still worsened to a loss of $102.9 million from a loss of $63 million in the same period last year. Due to these headwinds, I believe that investors would be more accepting of the weaker bottom line performance if there was a better sense of GameStop's timeline regarding its turnaround plans. Furlong did explain last night that the emphasis will be on driving strong revenue growth at the expense of short-term margins. While recalling his prior e-commerce experience, presumably from Amazon, GameStop CEO believes that revenue growth will ultimately translate into scale and market leadership. However, the management team did not offer formal financial guidance, nor did it find any or not find but field any questions during the Q&A session. Given that the company is in the midst of a major transformation, it's understandable that some investors may be dismayed by the more limited communications. The main takeaway is that GameStop remains a very risky stock due to the fundamental and speculative trading reasons. While the right management team seems to be in place to guide GameStop's turnaround, it's likely that the next few quarters will be rocky as it looks to reposition itself with a changing video game landscape, moving more towards experiences in the metaverse. What do you think about GameStop? Is it a company worth investing in for its change and future? Or is it just too risky? Let me know in the comments what you think. All right, that wraps up all the companies that I wanted to talk about in today's live stream. And I love answering your questions. So if you do have any, now would be a great time to ask some. One thing I would like to point out, if you could, it would be greatly appreciated if you could click that like button. And then second, take the link to this video and share it across your social media platforms that you use. That's very helpful. And then third, if you like my perspective on these different stocks, I know most of them aren't popular, but I'd rather find good stocks than just talk about popular stocks, if that makes sense. Then click the first link in the description below, because that helps our research, that helps with the analysis, technical breakdowns, and there are plenty of perks for you as well. From trade setups, buy-sell signals, to trade ideas like GameStop and how I just talked about GameStop. There are those exact segments that are for Patreon members. And I think it's a pretty valuable trade-off. You're helping us grow because I want to hire more researchers. I want to hire more journalists. And your help makes that possible. Because the more research that we can get done, the better these videos will be. And then the more you'll learn. So I think it's a fair trade-off. But it's obviously up to you. All right, investors, ladies and gentlemen, if there's no more questions, and I've got to the end of what I wanted to say today, I guess I'll go ahead and wrap this live stream up. I greatly appreciate all of you joining me today. I love the conversations and the questions every day. And I'll see you back here tomorrow around 5 p.m. Eastern. And I'll be here for an hour or two to chat, hang out, answer your questions, and of course, talk about a few stocks in between. So thank you, ladies and gentlemen, for joining me this evening, and I will see you in the next video.